What is an IPO? Have you ever wondered how a private company becomes available for everyone to invest in? How does a company go from being owned by a few founders to being owned by thousands or even millions of people? The answer is simple. It happens through something called an IPO, Initial Public Offering. Today, I'll explain exactly how an IPO works step by step. So, an IPO stands for Initial Public Offering. Initial means first time. Public means available to everyone, and offering means selling shares. So, an IPO is when a company sells its shares to the public for the very first time. Before an IPO, a company is private. It is owned by founders, early investors, maybe venture capital firms. After an IPO, it becomes a public company. Anyone can buy its shares through the stock market. That is the transformation. Well, why does a company launch an IPO? Now you might ask, why would a company sell ownership to the public? The biggest reason is raising money. Imagine a fast-growing electric car company. It wants to build more factories, expand to new countries, invest in research, and compete globally. All of that requires massive capital. Instead of taking huge loans, the company decides to raise money by selling shares. In exchange for money, investors get ownership. It's that simple. Now, let's break down. Step 1. Hiring investment banks. A company does not do an IPO alone. It hires big financial institutions called investment banks. Their job is to help the company prepare for going public. They study the company's finances, profits, risk, and growth potential. And they help decide how many shares to sell, at what price, and how much money can be raised. The process is called underwriting. Step 2. Regulatory approval. Before selling shares to the public, the company must provide full financial information to regulators. This includes revenue, profits or losses, debt, risks, future plans. Everything must be transparent because once you take money from the public, you must be accountable. After review and approval, the IPO date is announced. This is one of the most important parts. Pricing the shares. The company and investment banks decide the IPO price. If the price is too high, people may not buy. If the price is too low, the company leaves money on the table. So they analyze demand from big investors first. The phase is often called book building. Based on demand, a final price is fixed. Now the shares are ready to be sold to the public. IPO day, shares go public. On the official IPO day, shares are listed on a stock exchange. Investors place buy orders, and once trading starts, the market decides the price. Here's something important. The IPO price and the listing price can be different. If demand is very high, the price may jump above the IPO price. If demand is weak, the price may fall. The first day, movement often creates headlines. But long-term performance depends on business fundamentals. What happens after the IPO? Once the IPO is complete, the company receives the raised money. Investors now own shares. From that point onward, shares trade freely in the stock market. Early investors may slowly sell their shares, new investors may enter, and the company must now publish regular financial reports. It is no longer private, it is accountable to shareholders. So, who benefits from an IPO? There are three main beneficiaries. First, the company. It raises capital for growth. Second, early investors. They get an opportunity to sell their shares at public valuation. Third, public investors. They get a chance to participate in the company's future growth. But remember, an IPO is not guaranteed profit. Many people think if I invest in every IPO, I'll make quick money. That is not true. Some IPOs perform extremely well. Others fall below their issue price. Why? Because excitement and hype do not always equal strong fundamentals. A good investor looks at revenue growth, profitability, debt levels, competitive advantage, and industry future, not just social media excitement. IPO investing carries risk because the company is new to public. There's limited trading history. Valuations may be aggressive. Also, early price movements are often volatile. So, IPO investing requires research, not emotions. An IPO is simply a bridge between a private company and public investors. It allows companies to raise money. It allows investors to participate in that growth. But like all investments, it requires understanding. An IPO is not magic. It is not guaranteed profit. It is an opportunity. And opportunity rewards those who are informed, patient, and disciplined.